Thanks for your attention to this. Nobody wants to waste a lot of time on this. Okay, so we continue in talking about the income statement. The income statement is the only statement, well, no, the balance sheet is the only statement that addresses the issue of what in economics we would call a stock statement, telling what was at a given point in time. And remember, the balance sheet always is identified in the heading as either as of the end of the fiscal year or just giving you the fiscal year end, December 31st, for instance, March 28th. I haven't really talked so much, just as an aside, about the about year ends that companies will choose, but many companies do, by tradition, have a December 31 year end. But you also can imagine that for retail companies in particular, like Target or Walmart or whatever, that's a busy time of year, and there's a lot of things happening in the stores and at the home office. It's the biggest, certainly the several months leading up to Christmas for some companies will represent 70% of their annual revenues. You're familiar with the term Black Friday, right? What does that refer to? At least in the sense I'm talking about. What's Black Friday? It's that Friday after Thanksgiving, okay? Why is it called Black Friday? It's because for many companies, retail companies, that's when they actually cover their costs for the year. That is, that's when the money starts to flow in. So it's called Black Friday because being in the black means that you are good. You've got profits. What's the alternative to being in the black? Being in the, do what? Being in the red, okay? Being in the red. And if you look on, notice this, if you look on, well, it's probably in Excel, certainly, you can, when you are formatting your numbers, you can have it show negatives in red, okay? So that's how in the old days, when they kept records, you would keep your manual records in pen. It had to be in pen, not pencil, because it was a permanent record. And if you had losses, those would be written in red. So anyway, aren't you glad you came today and learned that? Well, the basic format is really simple. Revenues minus expenses. Revenues representing the amounts that we charge customers for goods and services we provide them. Expenses are the cost of resources used up in order to earn those revenues. And we've discussed already under the topic of the conceptual framework what it means to recognize revenues and expenses. Under the accrual basis, which is predominant, it's required under SEC regulations, companies that are required to report, that are publicly owned and required to comply with SEC requirements are required to use the accrual basis of accounting. Any other smaller company, if you've got a sole proprietorship or partnership, they can keep no records if they want to, except what's required by the Internal Revenue Service. They have to have adequate records to legitimately keep track of their revenues and expenses for tax purposes. But other than that, there's no requirement that a privately owned company would have any records at all. Realistically, they would have to if they want to go to the bank for a loan, because very often the bank is going to require that they have financial statements that have at least been reviewed by a CPA. And more often than not, if it's a significant bank loan, they're going to have audited financial statements. So realistically, they're going to have to conform to GAAP, which means they're going to have to record revenues and expenses according to the accrual basis, which means revenues are recorded when they are earned, and expenses are recorded when they are, what's the term? Incurred. Okay, we've talked about what those mean. Technically, revenues represent the increase in net assets from the firm's major operating activity. Expenses represent the decrease in assets from the firm's major operating activity. Walmart, for example, we know what they do. They're a discount retailer. They buy bags of Doritos someplace, they move them around and they sell them through their stores. But also Walmart, so buying and selling of consumer items for the most part is really what they do. That's their major operating activity. But you might not know this, Walmart has a pretty substantial real estate division. I once knew the VP for Walmart Real Estate. He's passed away now, but his name's Paul Carter, and he was actually the Harding University's College of Business is named after him. And let's say, for instance, that Walmart decides to refurbish a certain number of stores every year. That means that they will take out old shelving and old signage and that sort of thing and replace it with new. Well, what do they do with that old stuff? Well, they try to sell it. So they sell it to somebody like Ollie's or Fred's, some of the other and regional discount chains. Now, that's a sideline, but it's hopefully they intend for it to be something that makes them some money from this old signage. Let's say that they have got some old items that they can sell for, say, $50,000 that they have on their books at $30,000. So if you have this on your books for $30,000, you sell that for $50,000, you've got a gain as a result of that. But that activity really of selling off used equipment is not really part of their major operating activities. So if we were to take that $50,000 and throw it up into revenues, we would sort of be burying or let's say maybe even inflating the revenues. Because this revenue here is being representing the firm's major operating activity is something that investors and potential investors look at to see if it's something, well, for 1 year as a gauge of what they expect to happen in the following year. We believe that investors use the financial statements, including the income statement, to make judgments about the future. Not just to confirm what happened, although there's that value to tell what the company did, but that they also use that to make judgments about what the future holds for that company. And so we might understand that the normal recurring revenues of the company are something that represent an ongoing practice, ongoing operation, whereas the occasional selling of old equipment might not represent necessarily a predictable or continual activity. It might only occur sporadically in the company's life. And so what we want to do is to be able to distinguish revenues, again, representing the increase in net assets from the firm's major operating activity, from those things that occur only occasional. We very often refer to these as peripheral activities. Those of you, probably most of you know about peripheral vision. Okay, peripheral, what does that mean? Particular players, soccer players need good peripheral vision, for instance, in particular. I imagine, I don't know that golfers need it, I suppose you do somehow, but I don't, you keep your eye on the ball, don't you? Okay. Softball players, it's a lot, but you certainly, in soccer, you need to be able to see the field. So peripheral vision refers to what? What happens on the side? What's out here? Okay, you have to. It's always changing. The players are always moving. You can't just keep your head down or even look one way. You have to be aware of what's happening out here. So peripheral activities are those things that occur, those activities that occur on the side, and because they are sideline items, they don't represent the firm's major operating activity. We're going to distinguish between the income related to those activities and those that are ongoing. And peripheral activities will produce gains or losses in the situation I described, where the company has, let's say, signage, has equipment that has a book value, a cost of $30,000. If it sells it for $50,000, it experiences what we call a gain. If it sold that equipment with a cost of $30,000 for less than that, say $20,000, it would have a loss, in that case of $10,000. And this is classified separately on a multiple step income statement, something we'll spend some time on very soon. And the reason for the distinction is due to the importance of what we call recurring income. Again, we believe that investors use the financial statements to make judgments about the future, so they need to be able to distinguish elements of income that are expected to continue or recur from those that are occasional or just one-time events. Statement of stockholders' equity shows the changes in owners' equity accounts during an accounting period. We believe stockholders are pretty important, and that their investment in the company is important enough to need its own statement to show how the shareholders' investment has changed. Now, when there are no changes to, let's say the company doesn't issue or retire, well, I say issue or buy back stock, as we'll see buying back stock or repurchasing stock and retiring it are related, but not necessarily the same thing. But very often in a company's life, it may not have any changes to paid-in capital. It may issue stock or retire stock really only, rarely even. But it will, year to year, always have some change to retained earnings. And so when there are no changes in paid-in capital, as I like to say, this sort of collapses into a statement of retained earnings. Retained earnings beginning of year plus net income from the income statement. This ties into the income statement. Less dividends. Dividends represent current year distributions of profits equals retained earnings at the end of the year. Now, how do the statements articulate? So we've kind of had a whirlwind tour of the financial statements. In chapter 2 is where we go back and review. Let's say we whip through 4 or 5 chapters, I guess, of principles of accounting. And this is not something you'll find in your textbook, but I think hopefully it'll make, kind of ease you back into the financial statements, show how they fit together, and reinforce the form and the content of the financial statements as we go. Now notice what we've got here. I say, one of the basic requirements for you to be able to understand accounting data is to be familiar with the form and the content of these basic financial statements. And in fact, we're really focusing here on the income statement, the balance sheet, statement of owner's equity, and very, very narrowly, actually, the statement of retained earnings. Cash flows we're going to put aside for a while here. So notice here you've got a number of categories, line items from your various statements. For instance, what does this represent? That's really your income statement in a very simplified form of the income statement. And then you've got information like retained earnings, beginning of year, end of year, dividends declared, and those 4 items really, that's what you need to produce a statement of retained earnings, isn't it? And then, of course, we get into assets, liabilities, and equity, keeping in mind here that retained earnings is not repeated. It's an element in stockholders' equity. So there's your balance sheet. Well, if I gave you a little bit of time, you could, fill in the missing numbers here. You might have to think back to how the statements relate. And that's what I want you to be able to do. But there's actually, I found that it's helpful if we start with something like this. And so on the next page, we've got a template, as I call it, showing how these statements all interrelate. Now what I need for you to do is to, on that prior page, I think it is, if you got cases, okay, if you got cases with numbers, fill in the missing numbers from that first case into this template that you've got. Is it the last page or something? Anyway, it's not the last page, come to think of it, but fill in those missing numbers from the template. Yeah, let me see, from that case A, if you would, fill in the numbers. Now let me see if I've got the one that I wanted you to have. Yeah, we're good. Sometimes with this illustration here, I've simplified it a bit to use the accounts under equity for sole proprietorship. Instead of having paid-in capital and retained earnings, I've had just used just owner's equity or capital account. So in this template here, fill in the numbers that you've got from case A. And then let's work to fill in the missing ones. I think is that representative of numbers? Yeah. In other words, notice you're given revenues of 100,000, so plug that in up here. You're given net income of 40,000, dividends of, let's see, then there's, dividends declared of 50,000, ending retained earnings 120. Do you see what I'm talking about there? fill in the numbers that you're given,